Welcome class. Myself Professor D.S. Rai, Professor Department of Civil Engineering, BBD, ITM, Lucknow. We will cover a course KCE 076 Urban Transportation Planning. We have already covered 37 lectures and today lecture is lecture 38, in which we will cover net present value method and benefit cost method of economic evaluation. References I have taken Partho, Chakravarti Partha and Das Animes, Principle of Transportation Engineering, Papa Costa CS and Prevenderes PD, Transportation Engineering and Planning, Kadiali LR and Lal NB, Principle and Practices of Highway Engineering, R. Srinivas Kumar, Introduction to Traffic Engineering, S.K. Khanna and C.G. Justo, Highway Engineering. Some material have been taken from NAPTEL and some material have been taken from internet for this purpose. The contents today we will cover net present value method, benefit cost ratio method BCR, limitations of BCR, benefit cost ratio, a step to calculate benefit cost ratio BCR. So, we will take up one by one again. We have already started covered economic evaluation and now there are many methods by which we can go for the economic evaluation, but here we will take up only two method, net present value method and benefit cost ratio method for economic evaluation. So, first we go for net present value method. Net present value is the present value of the cash flow at the required rate of return of your project compared to your initial investment. This was told by Knight. In practical terms, it is the method of calculation of your return on investment or ROI for project or expenditure. By looking at all the money we expect to make from the investment and translating those returns into today's money or dollars, you can decide whether the project is worthwhile or not. Net present value method NPV. In this method, the stream of cost or benefit associated with the project over an extended period of time is calculated and is discounted at the selected discount rate to give the present value. The benefits are treated as positive and the cost as a negative, and the summation gives the net present value and PV. Any project with project positive NPV is treated as acceptable. In comparing more than one project, a project with a higher NPV should be accepted. The net present value will be equal to sum over year n total cash flow divided by 1 plus discount rate to the power n, where n is the year whose cash flow is being discounted. The net present value could be calculated by this formula NPV is equal to RT divided by 1 plus I to the power T, where NPV net present value, RT net cash flow at time T, I is the discount rate and T time of the cash flow. Advantage of the net present value includes the fact that it considers the time value of the money and helps the management of the company in the better decision making, whereas the disadvantage of the net present value includes the fact that it does not consider the hidden cost and cannot be used by the company for comparing the different sizes of the project. The net present value is one of the discounted cash flow technique used in the capital budgeting to determine the viability of the project or an investment. NPV is a difference between the present value of cash flow, cash inflow and the current value of cash outflow over a while. The cash flow are discounted to the present value using a required rate of return. A positive NPV donates a good recovery and a negative NPV indicates a low return. Below is a summary of the advantage and disadvantage of NPV. The net present value NPV or net present worth applies to a series of cash flow occurring at a different time. The present value of a cash flow depends on the interval of time between now and the cash flow. It also depends on discount rate. NPV accounts for a time value of money. It provides a method for evaluating and comparing capital project or financial products with cash flows spread over time, as in loans, investment, payouts from insurance, contract plus many other applications. The time value of money dictates that time affects the value of cash flow. For example, a lender may offer 99% for the promises of receiving $1 a month from now. but the promise to receive that same dollar 20 years in the future would be worth much less today to the same person or the lender, even if the payback in both cases was equally certain. This decrease in the current value of future cash flow is based on chosen rate of return, or you can say discount rate. If, for example, there exists a time series of identical cash flow, the cash flow in the present is the most valuable, with each future cash flow becoming less valuable than the previous cash flow. A cash flow today is more valuable than an identical cash flow in the future, because a present flow can be invested immediately and begin earning a return, while a future flow cannot. NPV is determined by calculating the cost, negative cash flow and benefit positive cash flow for each period of investment. After the cash flow for each period is calculated, the present value PV of each one is achieved by discounting its future value at a periodic rate of return, the rate of return dictated by the market. NPV is the sum of all the discounted future cash flow. Because of its simplicity, NPV is useful tool to determine whether a project or investment will result in a net profit or a loss. A positive NPV results in profit, while a negative NPV results in a loss. NPV measures the excess or shortfall of cash flow in the present value of terms above the cost of funds. NPV is a central tool in discounted cash flow DCF analysis and is a standard method for using the time value of money to appraise long term project. It is widely used throughout economics, financial analysis and financial accounting. In the case when all future cash flow are positive or incoming, such as principal and a coupon payment of a bond, the only outflow of cash is the purchase price. The NPV is simply the present value of the future cash flow minus purchase price, which is its own present value. NPV can be described as the difference amount between the sum of discounted cash inflow and cash outflow. It compares the present value of money today to the present value of money in the future, taking inflation and return into accounts. NPV of a sequence of cash flow takes as input the cash flow and a discount rate or discount curve and outputs a present value, which is the current fair price. The converge process in the discounted cash flow DCF analysis takes a sequence of cash flow and a price as input and as output the discount rate or internal rate of return IRR, which would yield the given price as net present value. This rate called the yield and is widely used in a bond trading. Many computer based spreadsheet programs have built in formula for PV and NPV. Now, we come for example, it has been taken from internet. For example, we can see here, this is example of net present value calculation. We see here A, B, C each have 1 lakhs to spend on a rental house by the end of year 1. Whoever buy the house will have earned 9,000 in rent after paying all expenses, and the owner will then sell the house and earn 1,03,000 after paying all closing expenses. Each of them has a different requirement for their investment. A would like to earn 4.5% return, B would like to earn 12% return, and C would like to earn 13%, whose investment need will be met by buying the rental house. So, this is the example we see here. This is A, B and C. The initial investment in all A, B, C have initial investment 1 lakhs. Cash income from rent by the end of year 1. So, everyone have 9,000. Cash income from asset sale at the end of year 1,03,000, 1,03,000. Total year first income. So, this is the 1,07,177, 1 lakhs and total year 1,12,000, 1,12,000 and 1,10,000. They all have 1,12,000. The present value of year 1 income as the selected discount rate, that will 1,07,177. This has only 1 lakhs and this is 99,114. So, what is the net present value or the difference between the present value and the necessary investment of 1 lakhs? So, A has 7,177, B has 0, and D C is minus 886. So, we can say here A net present value is positive, which means the investment will exceed A requirements. B, the net present value is 0, which means the investment will exactly meet the B requirement, and C, net present value is negative, which means the investment will not meet the C requirement. So, we can say A is the best. Now, come to the cost benefit ratio method, BCR. In this method, all cost and benefit are discounted to the present worth, and the ratio of benefit to cost is calculated. The negative flow are considered as the cost and positive flow are benefit. If BC ratio is more than 1, the project is worth undertaking. The benefit cost ratio, BCR, is the ratio used in cost benefit analysis to summarize the overall relationship between the relative cost and benefit of a proposed project. BCR can be expressed in monetary or qualitative terms. Benefit cost ratio are most often used in the capital budgeting to analyze the overall value for the money of undertaking a new project. The cost benefit analysis for a large project can be hard to get right because there are so many assumptions and uncertainty that are hard to quantify. This is why there is usually a wide range of potential BCR outcomes. The BCR also does not provide any sense of how much economic value will be created, and so the BCR is usually used to get a rough idea about the viability of a project and how much the internal rate of returns exceed the discount rate, which is the company weighted average cost of capital. The opportunity cost of that capital. The BCR is calculated by dividing the proposed total cash benefit of the project by the proposed total cash cost of the project. Prior to dividing the number, the net present value of the respective cash flow over the proposed lifetime of the project, taking into account the terminal value including salaries, remediation cost are calculated. The cost benefit ratio is indicator showing the relationship between the relative cost and the benefit of a proposed project expressed in monetary or qualitative terms. If a project has a BCR greater than 1, the project is expected to deliver a positive net present value to a firm and its investors. If the project BCR is less than 1, the project cost overweight the benefit and it should not be considered. If the project has a BCR that is greater than 1, the project is expected to deliver a positive net present value and will have an internal rate of return above the discounted rate used in DCF calculation. This suggests that the NPV of the project cash flows outweigh the NPV of the cost, and the project should be considered. If the BCR is equal to 1, the ratio indicates that the NPV is expected profit equal to the cost. If the project BCR is less than 1, the project cost outweigh the benefit and it should not be considered. The benefit cost ratio is determined by dividing the proposed total cash benefit of a project by the proposed total cash cost of the project. The cost benefit ratio is an indicator showing the relationship between the relative cost and the benefit of a proposed project expressed in monetary or the qualitative term. If the project has a BCR greater than 1, the project is expected to deliver a positive net present value to a firm and its investors. The primary limitations of the BCR is that it reduces a project to a simple number when the success or failure of the investment or expansion relies on many factors, and that can be undermined by unforeseen events. Simply following a rule that the 1 means success, below 1 spells failure in misleading and can provide a false sense of comfort with the project. BCR must be used as a tool in conjunction with other type of analysis to make well informed decision. The steps to calculate the BCR. The first step is calculate the present value of the benefit expected from the project and procedure to determine the present value. The amount for each year cash inflow multiplied by present value factor. The aggregate the amount of all years. Step 2, to calculate the present value of cost. If the costs are anchored up front, the cost anchored is the present value of the expenses as there are no PV factors. Step 3, calculate the benefit cost ratio using formula. BCR formula PV of present expected from the project divided by present value of the cost of the project. So, here there is a example of the cost benefit VCR example. The mayor of a city is evaluating two transportation project A and project B. Project A has a present value of the cost is 20, benefit expected from the project is 40 lakhs. The present value of the cost is 20 lakhs. The project B, the present value of the benefit expected from the project is 60 lakhs and the present value of the cost is 20 lakhs. Calculate the benefit cost ratio and evaluate which project should be undertaken. So, for the project A, we can see here 40 lakhs, 20 lakhs. So, the cost benefit ratio will be B3 by B4. So, here is the amount 40 lakhs and here is the cost is 20 lakhs. So, cost benefit ratio will be 40 by 20, that will be 2. So, here cost benefit ratio is 2. The project B, we can see here the benefit is 60 lakhs, whereas the cost is 20 lakhs. So, B8 by B9. So, the cost benefit ratio will be 3. So, we can say the project B could be taken up on the basis of the benefit cost ratio. So, thank you very much.